John, it's crazy when you look at what, first of all, what the credit space is doing, what treasuries are doing, what even the German 2-year Bund is doing. What does it mean about A, the state of the economy, and 2, what does it just mean for asset classes?
If only there was a one-line answer. And if we look at what's driving Treasury markets first, that probably gives us a bit of a clue as to what's going on in credit. So if we look at what's going on in Treasury markets, ultimately it's a repricing of growth expectations, and certainly it's weighing in the fact that the Fed could yet, at Jackson Hole, change the way in which they think about inflation over the longer term. So they could indeed take a more proactive approach from that perspective, which at the margin is dovish. It also reflects supply and demand. Bear in mind, global yields are quite well correlated.
Yep.
And we've just come through 2 months, April and May, in Europe, where the net supply, once you take into account coupons and redemptions, has actually been negative. Lay on risks around global growth, and there's lots of things going on which have all acted together to pull global yields down. If we look at the underlying economy in the US, as we spoke about it a bit earlier, actually the baseline is going okay. Not spectacular, but it's sort of looking like trend-like in our view for this year. So what does that mean for treasuries? Well, we think that somewhere between 2.25 and 270, 280 is the kind of range that is fair. So we're at the bottom of that range.
But not 2%.
2% to us would not reflect the strength of the US economy. Could we get there? There's certainly a risk. If we get a further scare around global growth, then the idea that we could see other buyers of bonds come in, particularly those who are hedging mortgage books, could mean that we could spend a little bit of time down there. But the reality is the fair value range, given what the Fed have telegraphed as being pretty resolutely on hold and what we see as global growth within the US, we think we're towards the bottom end of that fair value range right now. What does it mean for credit? Well, the reality is we don't see a recession coming in the next 12 months.
Right.
Even allowing for the yield curve inversion that we've seen, typically that's a signal that has a long lead time, typically 12 to 18 months. And we've got a very easy Fed. Under those circumstances, while there are some cracks showing around elements of corporate credit, as your interviewees had alluded to, ultimately, in the absence of a recession with relatively easy monetary policy, credit is still a reasonably attractive carry class. But you do have to be mindful of what you're dealing with, which is an economy which is in late cycle.